So here we will wind up with our first method of measuring national income. That was your value added method, wherein we understood about the meaning of value added. We saw its formulas as well as the precautions which we have to take while computing value added method. Next method which will be used for measuring national income is income method. With the name itself, you all might have gotten the idea. Income method will include all the factor incomes. What are the factor incomes? So, you all should remember wages, rent, interest and profit. So, all these factor incomes will be included under income method. And these factor incomes, from where are we getting this factor incomes? We are getting it from factors of production, land, labor, capital, entrepreneur. The returns of it is rent, wages, interest and profit. So, in this income method, we will be only including the incomes of the people. Okay, income of the people will be summed up, and then with the help of that we will find out the value of national income. So, let us move ahead with it. Income method measures national income from the perspective of factor income. Factor incomes, rent, wages, interest and profit. Factor incomes, rent, wages, interest and profit, which we get from factors of production, that is land, labor, capital and entrepreneur. So, under this method, income received by all the residents of a country for their productive services during a year adds up to obtain the national income. Only and only productive service, any service or anything which is unproductive happening in the economy, in the country, will never be included under national income. So, we know land, labor, entrepreneur, capital, all of these are nothing but a productive service. Something productive is happening because of them. Some goods and services are being produced because of these four factors of production. So, whatever returns they are getting will be summed up together to form income method. Okay. According to this method, all incomes that occur to factors of production by way of wages, profit, rent and interest are summed up to obtain the national income. So, under this method, we are going to sum up the income of factors of production in the form of rent, wage, interest and capital. Okay. Income method is also known as distributive share method and factor payment method. So, the other name or alternative name of income method is distributive share method or factor payment method. The sum total of all factor incomes earned within the domestic territory of the country is called as domestic income. So, the aggregate which we get here of income method is NDPFC. The aggregate of value added method was GVAMP. Also, it can be called as GDPMP. But the aggregate of income method is NDPFC. Net domestic product at factor cost. Remember, we have studied the definitions of all the aggregates in our previous video. If you have not watched that video, then please go and watch that video and then come to this video. Only then these things will be helpful for you all. Okay. So, the aggregate of value added was GVAMP or GDPMP. Aggregate of income method is NDPFC. Now, next very important thing to understand are the components of income method. What are the major components of income method? Because with these components, we are going to form a formula. So, first component is compensation of employees, which is known as COE. Compensation of employees. With the name itself, we should understand compensation of employees means the returns which we are giving, the benefits, returns which the employer is giving to his employees for providing their services. Okay, that is nothing but compensation. So COE refers to amount paid to employees by an employer for rendering productive service. Say suppose A and B. A is an employee, B is an employer. A is giving what? A is giving services to B. So in return, what should B give to A? B should give some kind of compensation to A since A is providing him the services. Okay. So it includes all the payments and benefits which the employees receive directly or indirectly from the employer. So compensation of employees will basically include all the payments, all the benefits which the employees will be receiving directly or indirectly from their employer. Why employer will be giving this compensation to employees? They will be giving this compensation to employees because employees are providing their services in their organization. Okay. So now let us see the elements of compensation of employee. Component of income method was compensation of employee. Now there are few elements of compensation of employee. First element is wages and salaries in cash. So when the employer gives some benefits in the monetary terms or in money terms, it is called as wages and salaries in cash format. So it includes all monetary benefits like wages, salaries, bonus, dearance allowance, commission, etc. Okay, so first element of COE is wages and salaries in cash. That means when the employer is giving his returns to the employees in the form of cash. So it could be anything: wages, salaries, bonus, dearance allowance, commission, etc. Second, wages and salaries in kind. Anything which they are giving you in kind. It is not in the money format. It is in the non-monetary format, non-money format. So this includes all the non-monetary benefits like rent-free home, free car, free medical and educational facilities. Imputed value of this benefit should be included in national income. So rent-free home, there are many companies who give accommodation to their employees. Okay, many employer give accommodation to employees. They give rent-free home, that okay fine, you can live in this home without paying rent. Okay, so rent-free home, rent-free car, education to their children, medical facilities to their family, all these will become the part of wages and salaries in kind. It's also a compensation given to employees from the employer. Third is employer's contribution to social security scheme. It includes contributions made by employer for social security. Now, every employee need some kind of social security. So, here also employer is going to contribute something for the safety and security of his employees. So, example here could be PF, that is Provident Fund, gratuity, labor welfare fund, etc. So, employer's contribution to social security scheme in order to provide safety and security to his employees. So, these three are nothing but the elements of COE, that is compensation of employees. Second is rent and royalty. Okay, rent. Mostly we give if we are working on somebody else's land. If we have bought the machinery on rent, it does not completely belongs to us. I have bought it on rent from somebody else. If I am staying in somebody else's house, I will have to give that person a rent. And royalty, let us see. Rent is the part of national income which arises from ownership of land and building. Ownership of land and building. Rental income includes both actual rent, rent let out of land, as well as imputed rent, rent of self-occupied property. So, when we talk about rent, we will be including actual rent plus imputed rent. Okay, both the forms of rent will be included. Imputed rent of owner occupied house is calculated on the basis of market renter value of the house. If house A and B are situated at the same place and A has to give rent of 500 rupees, but B is living in a self-occupied house. His house is himself. He is not staying on rent. But the market value of the house is 500 rupees. So, we will be taking or considering 500 rupees, and that will be also included in national income. This will become your imputed value and this will become your actual value. So, both actual rent as well as imputed rent will be included while computing national income. Royalty, it means nothing but income received for granting lease rights of subsoil asset. Example, owner of minor deposit like coal, iron ore, natural gas, etc. can earn income by giving rights of mining to the contractors. Right is completely in the hands of A, but A is giving this right to some kind of contractor. So, whatever income is incurred by the contractor, he will have to share certain amount of that income with A. So, this whatever the income he will be getting, A will be getting, it will be called as royalty. Again, imputed royalty as well as actual royalty are included. Interest. Interest is what? Which you pay on buying or borrowing money from someone. If I go to a bank and ask for a loan, bank will give me loan, but will it give me for free of cost? No. Bank will be charging some kind of interest from me. So, interest refers to amount received for lending funds to a production unit. It includes both actual interest as well as imputed interest of the fund provider. Interest income includes interest on loans taken for productive service only. Now, here we will be including only those loans and those borrowings which have been taken for some productive service. If you have not taken the loan for some productive activities, then that will be not included. But rest apart from that, it will be included. What will be not included? Interest paid by government on public debt and interest paid by consumers. As such, interest is paid on loans taken for consumption purpose. Interest paid by one firm to another firm. If firm A is paying interest to firm B, this will be not included in national income. Okay? And if government is paying interest on the loan, that will also be not included. So, we know in interest what things are included and what things are not included. Profit. We all know what is profit. Okay. So, it is nothing but the reward for the entrepreneur for his contribution to the production of goods and services. Profit is nothing but a reward for the entrepreneur for producing the goods and services, for bearing all the risks, for bearing all the uncertainties. So, those are the returns for the entrepreneur. It is a residual income which entrepreneur earns after paying to all the factors of production. So, factors of production is land, labor, capital, entrepreneur. Income was for 1000 rupees. So, on land we have to pay rent, labor we have to give wages, on capital we have to pay interest, and the remaining amount goes in the hands of entrepreneur as a profit. So, say suppose here we have paid 200, here we have paid 200, here we have paid 200. Now, out of 1000, 600 has been already paid. So, the remaining is 400. So, this 400 will be nothing but the profit of the entrepreneur. Okay, the returns which the entrepreneur gets. Now, the profit earned by an enterprise is used for different purposes. So, now we have few elements for the profit as well. First one is corporation tax. Corporation tax is nothing but the tax which businesses, which firms has to pay to the government. So, it is a direct tax paid by the enterprise to the government on total profit earned by it. It is also known as profit tax or business tax. So, say suppose the firm has earned the profit of 2000 rupees, then government will say that 3% you have to pay to us in the form of corporate tax. It is also known as profit tax or business tax. Second is dividend. Dividend is nothing but the part of profit which we are going to give to our shareholders in the form of their returns. So, part of profit paid to the shareholders in the ratio of the shareholder, it is also known as distributed profit. Okay, this you all should know what are the alternative names, because when we will start solving numerical questions, everything has the alternative names. So at that moment you will be getting confused that what is this. So the alternative name for corporate tax is profit tax and business tax. Dividend, the thing is distributed profit. And third is retained earnings. So it refers to the part of profit which is kept as reserve to meet unexpected contingencies or for business expansion. Okay, dividend retained earnings means after distributing the profit to everyone, still there is some amount left. So that amount will be going to the reserves account of the company, and those reserves will be used in the emergency of the company or for expansion of company. Again, retained earnings are also known as undistributed profit, saving of private sector or reserves and surplus. So as we were discussing the components of income method, wherein the first one we already discussed, that was COE, compensation of employees, which includes salaries and wages in cash, salaries and wages in kind, employers' contribution to security scheme. Then we talked about rent and royalty, profit, interest. Next is operating surplus, which we also call it as OS in short form, that is operating surplus. So operating surplus is nothing but the other term used in factor payments. It refers to sum total of income from property like rent plus royalty plus interest plus income is nothing but your operating surplus as well as profit. So when these components are summed up, we get operating surplus in a very simple language. Next come is mixed income. What do we mean by mixed income? Here what you can understand from the term, we are talking about the income which is of a mixed nature. That means one person can get income from different particular things. For example, I as a person can receive rent from the land. I might be working somewhere, so I also receive salary. So rent and salaries are two different kind of incomes which I am earning. So in that scenario, in under which category I would be put in. So that is why we have come up with a new category, that is mixed income. So any individual who incurs multiple type of incomes can be come under the topic of mixed income. So it is income generated by own account workers like farmers, barbers, etc. and unique operated enterprises like retail traders and small shopkeepers. It is some term used for any income that has elements of more than one type of factor income. As I said, rent and salary is received by one person. So that means it is a multiple type of factor income which a one person is receiving. So in that category, I cannot put him under rent. I cannot put him under salaries and wages in cash. So in this case, the person will come under mixed income. So it arises from productive services of self-employed person whose income includes wages, rent, interest and profit, and these elements cannot be separated from each other. Example, income of a doctor running a clinic at his own residence. So mostly all those people like businessmen or self-employed people who does productive services comes into the category of mixed income. An example is of a doctor. Say suppose doctor is running his clinic at his own house. The house is self-occupied by him, and in that same house he is running his clinic. So he does not have to pay rent, but still we will be calculating imputed rent. Remember, we have already talked about it. Then salary, he himself is working, so salary is also received by himself. Then no capital he has borrowed from bank, so in no interest. All the profit he is only receiving because there is nobody else who is working with him. So every kind of income is received by this one particular doctor. So in that case, this person, this doctor will come under the category of mixed income. Now next, let us look the formula of it. NDPFC, as we know, income method, the aggregate of income method is NDPFC, that is net domestic product at factor cost. Formula is COE, that is compensation of employees, plus rent and royalty, plus interest, plus profit, and plus mixed income. Now we have talked about all the components like compensation of employees. The formula will be, if directly it is given to you in the question, then well and good. If it is not given to you directly, then in that case you should know the formula of COE, that is wages and salaries in cash plus wages and salaries in kind plus employee contribution to social security schemes. So that is COE. Profit, again we know profit has three divisions: corporate tax plus dividend plus retained earnings. So if profit is directly given to you in the question, no problem. But if not, then in that case the formula is corporate tax plus dividend plus retained earnings. Profit, profit is nothing but rent plus royalty plus interest plus profit. So this is nothing but operating surplus. Operating surplus is equals to rent plus royalty plus interest plus profit. And there is one more very important formula. Usually we ignore this formula, but it is a very important formula and it gets in the question. It comes in the question. That is, income from domestic product accruing to public sector is equals to saving of non-departmental enterprise plus income generated from property and entrepreneur to government. This is also a very important formula. Coming towards the precautions of income method, that means when you are calculating national income using income method, what are the precautions which you have to take care of? What are the certain things about which you have to keep things in mind? First, transfer incomes. So transfer incomes are never included in national income, neither in domestic income. We already know income can be of two types: factor income and transfer income. Factor income are those incomes which are earned after providing some services. Transfer income are those income which are received without providing any productive services in the economy, like scholarship, donation, charity, old age pension, etc. Second, income from sale of second-hand goods will not be included in national income. Yes, we have already discussed this. Income from sale of second-hand goods will not be included while computing national income because that transaction has already been included in while that actual transaction had taken place. So again, in the current year, we will not include that transaction. Yes, but if there is any brokerage or commission charged while the sale of the goods, sale of second-hand goods, then that will definitely be included in national income since it's a current and a fresh transaction. Third, income from sale of shares, bonds, debentures will not be included as such transactions do not contribute to current flow of goods and services. So, any income received from financial assets like shares, bonds, debentures, equities, preferences, etc. will not included in national income because we say that these things are nothing but the financial assets and they are nothing but paper claims which will just involve the change in the name of title. For example, I am the buyer and you are the seller of shares. We will be just exchanging the documents and the papers. Here there is no asset involved. Here no current asset is involved. So any commission or brokerage charged on financial asset will definitely be included in productive services. If there is any brokerage or commission getting charged on these things, as we know there are brokers, right, who help the issuers and the investors to come into the contact with each other. So those brokers are not going to do that work for free of cost. Of course, they are going to charge certain amount of commission or brokerage. So when that thing is charged, that will definitely be included while computing national income. Next, always avoid capital gains. What are capital gains now? So they are nothing but income received from sale of second-hand goods and financial assets like bonds, debentures, shares. So capital gains are nothing but two things. First, it is the money or the income which you are receiving from the sale of second hand goods. Secondly, it is the sale of financial assets like shares, debentures, preferences, equities and etc. So, any income arising from such transaction is not a factor income, as these transactions are not productive transactions and do not add to current flow of goods and services in the economy. So, these kind of transactions are nothing but the factor incomes. So, as we have already said that these kind of transactions are not productive transactions in the economy, and hence we will not be including those in the national income. Then comes your windfall gains. What are windfall gains? So, windfall gains is nothing but your illegal money. Okay, the money which you are earning in an illegal format. Okay, the money is not legal, like income earned from lotteries, horse race, okay, etc. are not included, as there is no productive activity connected with them. This is nothing but just a kind of entertainment. It is not generating any kind of productive thing in the economy, and that's why we will not be including it in national income. Sixth, imputed value of services provided by owners of production units will be included, as we have already said that imputed values are always included while computing national income. Imputed values are nothing but the imaginary values. So, imputed rent, imputed profit, imputed interest, everything will be included. Payments out of past savings like death duties, gift tax, interest tax, etc. are not included in national income because they are paid out of wealth or past saving and do not add to current flow of goods and services. Any payment which you are doing from your past savings or past wealth, that kind of payments or that kind of transactions will be not included while computing national income. For example, in 2018, you have made some savings, and current year, that is 2022, you are spending these savings. So, in 22, when we calculate national income, you will be not including this thing, this transaction, because here the transaction has been done out of past savings and past wealth. So, such kind of transactions are not included in national income. So, that's with the income method. The last and the important method is your expenditure method. What exactly expenditure method is? So, let us move towards it. With the name itself, you can understand expenditure is nothing but expenses. That is what expenditure means. Expenses which we do. Expenses means when we spend money, it's an expense for us. So, that is what the expenditure method is. So, yes, factor income earned by factors of production is spent in the form of expenditure on purchase of goods and services produced by firms. If you all remember, in the starting videos, we have already talked about something called as circular flow of income, wherein we understood that how the income is flowing between the two sectors, that is household and firms. So, same thing they are saying over here, that whatever factor income is earned by people, ultimately they are going to spend it on the purchase of goods and services. It will become an expense for them. So, this method, national income, as sum total of final expenditure incurred by households, business firms, government and foreigners. So, if you all remember, we have talked about sectors of an economy, and I had already said that there are 4 sectors in an economy. Okay, there are 4 sectors in an economy. So, the expenses made by all the 4 sectors will be included in this particular method. So, total final expenditure is equals to GDP at MP. This is also known as income disposable method. So, expenditure method is also known as income disposable method, and the aggregate of expenditure method is GDP at MP. Components. Now, very important, we should know what are the components of expenditure method. The first component of expenditure method is PFCE, that is private final consumption expenditure. So, all the expenditure done by the private people, private household is going to be considered over here. So, expenditure incurred by household and private non-profit institution serving households on all the types of consumer goods, that is the durable goods, except houses, very important, semi-durable, non-durable goods and services. So, PFC basically includes all the expenses done by households as well as private non-profit institutions, all the kind of on the different kind of goods, be it be a consumer good, be it be a durable good, semi-durable good or a non-durable good. So what is the formula of PFCE? Household final consumption expenditure plus private non-profit institutions serving household final consumption expenditure. If PFC is directly given to us in the question, no problem. If it is not, then the formula for it is household final consumption expenditure plus private non-profit institutional serving household final consumption expenditure. So PFC includes expenditure incurred by all the normal residents, whether in the domestic territory or living in the abroad. So PFC will include all the transactions done by normal residents, be it be within the domestic territory or outside the domestic territory. Any expenditure incurred by resident during the foreign tour or travel will be added in PFC. If I am going out of the country and doing any kind of expenses, that will be added under PFC. However, any expenditure incurred by non-resident and foreign visitors in domestic market will be deducted from PFC. So, if any non-resident is doing any kind of transactions or if a foreigner is coming in our country and doing this transaction, then that will be deducted. Second is GFCE, that is Government Final Consumption Expenditure. This refers to the general government on various administrative services like defense, law, order, education, etc. Government produces goods and services with the aim of social welfare without any intention of earning profit. That we know the major task or major motive of government is always to do welfare of the people. All the transactions done by the government is for the welfare of people. So, no profit motive is there. So, all the expenses done by the government will come under GFCE. Now, how do you estimate GFCE? First, it is equal to the cost of goods and services produced by government for collective use by the public. All the cost for producing goods and services done by the government for all the people living in the economy, these services are valued at their cost to the government as they are not normally sold to the public. It means GFCE is calculated as, how are we going to calculate GFCE? Intermediate consumption of government plus COE paid by government plus direct purchases from abroad for embassies and consulates located abroad minus sale of goods and services produced by general government. Now, why are we subtracting this particular thing? Because sale of goods and services produced by the general government will be nothing but the profit for the government. So, profit we are not going to calculate over here. Profit is nothing but the income for the government. So, as we are talking about expenditure method, we are not going to consider the incomes of the government. So, that is why this will be the formula. Third is GDCF, that is Gross Domestic Capital Formation, which is also known as gross investment. It refers to addition to capital stock of the company. So, GDCF is nothing but the addition, increasing the capital stock of the economy. It represents the expenditure incurred on acquiring goods for investment by the production units located within the domestic territory. So, all the expenses done on acquiring the goods or by the investment in the production units which is located in the domestic territory. So, two components of GDCF. First component of GDCF is GFCF, that is GFCF, Gross Fixed Capital Formation. So, it refers to the expenditure incurred on the purchase of fixed assets and it is divided into three subcategories. So, gross fixed capital formation, with the name itself we should understand that it will include the expenses done on the fixed assets, fixed capital. Again, it is of two types. Now, investment of fixed capital can be of three types. First, gross business fixed investment, that you are going to do the investment in your business by investing in new plants, machinery, equipments, etc. B, gross residential construction investments. So, this will include expenditure on purchase or construction of new houses of the household. Under PFC, we will not include the purchase of house or houses. But here under GFCF, we are going to include purchase of house, reconstruction of house and etc. And C is gross public investment, which means expenditure done on constructing flyovers, roads, dams, bridges, etc. Because all these constructions are done from the expenses of the government. No private people is going to go and make a bridge or a dam, right? Government is going to do all the expenses for such constructions. So GFCF is nothing but the expenses done on the fixed assets. Gross business fixed investment, investment done on business. Residential construction, investment done on your reconstruction of house or new house. Public investment, investment done by the government in order to construct flyovers, bridges, dams, and etc. Second is inventory investment. It is nothing but change in stock, which refers to physical change in stock of raw material, semi-finished goods and finished goods lying with the producers. It includes investment item because it represents goods produced but not used for current consumption. This is nothing but your stock. Goods are being produced but not yet used for the current consumption. This will be calculated as the difference between closing stock and the opening stock. That means your CS minus OS. So, the formula becomes as CDCF is equals to gross fixed capital formation plus inventory investment, and GDCF is equals to gross business fixed investment plus gross residential construction investment plus gross public investment inventory investment. Inventory investment is your closing stock minus opening stock. Next is net exports. Net export is always X minus M. X is exports, M stands for imports. So, difference between export and import of the country will be called as net exports. Export refers to expenditure by foreigners on purchase of domestic products, and exported goods have been produced within the country's domestic territory. So, they will be included in the output of an economy. Example, India has produced a good and USA is buying that a good from India. So, that means India has exported the goods and India will be receiving the payment. Whereas, import is the expenditure by resident on foreign products, and imports are deducted to obtain domestic product as they are not produced within the domestic territory. Instead of treating export and import separately, difference between the two is taken as net exports. So, next is the precautions of expenditure method. That is, what are the precautions which you have to take while computing national income using expenditure method. So, various precautions to be taken while using it is expenditure on intermediate goods will not be included in the national income. We have already discussed this, that all the final goods, value of final goods will be included in national income. Value of intermediate goods are never included. Transfer payments are not included. Yes, only and only factor incomes are included in expenditure method. No transfer income will be ever included. Purchase of second hand goods will not be included because they have already been included in the year when they were originally purchased. So, in the current year, we will not be including them while computing national income. Only the brokerage and commission charged on the current year on that particular good will be included. Purchase of financial assets are never included because it is considered that this is just the mere transfer of papers and there is no productive service or anything productive happening in the economy. So, here again we will not be including the purchase of financial assets. Expenditure on own account production, like production for self-consumption, imputed value of owner-occupied house, free services from general government and private non-institution serving households will be included in the national income since all of these are the productive services. So, all the expenditure done on own account production, production for self-consumption, imputed value of owner-occupied house, that is imputed rent, imputed profit, free services given from general government, private non-institution, everything will be included while computing national income. So let us just see the quick full forms. PFCE stands for Private Final Consumption Expenditure. GFCE stands for Government Final Consumption Expenditure. GDCF stands for Gross Domestic Capital Formation, and NE stands for Net Exports. So GDPM, the formula, let us look at the formula of expenditure method. GDPM is equals to PFC plus GFC plus GDCF plus net exports. So GDCF, if directly it is given, well and good. If not, then formula is gross fixed capital formation plus inventory investment. GFCF, gross business fixed investment plus gross residential construction investment plus gross public investment. Inventory investment, which is also called as change in stock, formula for it is closing stock minus opening stock. Purchase, note, very important note, purchase of new house, investment, capital formation will not be included in PFCE. So this is it. Here we talked about all the important methods which are used for measuring national income: value added method, income method, and expenditure method. We understood the meaning of methods, formulas of method, components, and the precautions. If you notice, the precautions for all the three methods are somewhere around same. So if you learn one precautions properly and nicely, the other two are going to remain the same. Thank you for watching our video. For more updates, reach us on www.tgcampus.com or 1800-267-2677 or connect@tgcampus.com. Like and subscribe to our YouTube channel TG Campus In. Follow us on Instagram, Facebook and WhatsApp. Join our official Telegram channel TG Campus In. Chat with us on 8655682401.